Insane shipping rates, 135,000 a day. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee, we're going to do another video talking about global shipping, and this is an article sent to me by a viewer just highlighting a container ship with fantasy charter rates, insane amounts of money. We're all in the wrong business, guys. You know, we got to get, forget about property, guys. Australia needs to start shipping again. Well, if only we did. We don't even have a merchant fleet, do we? How many ships are running the Australian flag? I doubt many are. But anyway, let's have a look at that. Before we jump to this, I want to just bring up an image which shows you, well, this was captured last night, all of the international shipping around the world there. So you can see just how much is flowing. All of here, the iron ore is flowing out of Australia up to China. You've got coal and other resources flowing to China from Australia. You've got gas and other stuff coming from here. So we're a very interconnected international world. And in some regards, the revolution of container shipping, how efficient it is, and we can just have a look at this picture here, how efficient this is compared to shipping back in the day, has rendered some of the trade blocks like the EU and other things completely, well, moot in some regards. And the world is opening up more and more. And there's some people who are worried about international trade and are concerned about it. But you've got to understand, quality of life for a lot of people all over the world has significantly improved. For some, it's gotten a bit worse, but for others, it's gotten a lot better. And even the worst of us, the poorest of us here in Australia, are still doing it much better than, well, people in other countries around the world, everyone. So we'll have to see. But the only problem with this is it means you've got to compete with the entire globe, at least for your manufacturing, at least for your exports and your imports. That's just how it is. You can't have that super cheap plasma TV and expect it to be made in Australia, can you? Not with our red tape, legislation, and property and energy prices, among other things. So here we have container freight prices. This is the Freightos Baltic Index, the FBX Global Container Index. And we can see here now we're at $5,443. So last time I was looking at this chart, it was around here. There was a 4 in front of this. And it's gone up again, everyone. It's just climbing up, just shooting up. Okay, this was average back in the day. Back in the day in January 2020, September 2019. Look at that. Look at shipping. Now, this adds weight to the argument that some of the inflation that we're seeing is transitory. Because this is insane, how high it's going. It has to work through the system. This is how much it costs to go from China to the west coast of America. So $5,560. There we go. Look at that. Boom. Now, if you're seeing this, you might be thinking, Florian, shipping containers. What if I could buy them and then lease them to companies? Watch out. There's scams that offer that type of thing. I'd rather buy into companies that, well, do the shipping. Shipping companies or own the ships if you're looking at trying to take advantage of this. So, and here you have going back from the North American West Coast back to China. Even that is now approaching $1,000, $972. And remember, a lot of them are empty. A lot of the shipping containers are empty going back. But see, look at that. It's jumped right up as well. So let's have a look at this article, which is, $135,000 per day, everyone. And shipping is, it doesn't cost too much. These prices we saw, they're the cost of shipping a container full of stuff around the world from one part to the other, from China to the west coast of America. So you could fill it up with a whole lot of stuff, pay $5,000 to ship it over, and that's gonna, well, you're gonna have to absorb that additional shipping cost in all of your goods. The same thing is happening here. Stuff coming to Australia. I've got a lot of viewers who are sending me. Well, that's why building products are getting more expensive too. Viewers were sending me, price advisors from their shipping company saying our costs are planning to go up here and here and here because it's just going crazy. So the container ship scores off the charts fantasy charter rates of $135,000 per day. Record high charter rates highlights the extreme vessel shortage, a major negative for cargo shippers. So, in a sign of just how frenzied the container market has become, a freight forwarder is reportedly paying $135,000 per day for a short-term charter of the S. Santiago, a 15-year-old container ship with a capacity of 5,060 20-foot equivalent units, TEUs. And those are the prices that we were looking at there. That's a 20-foot shipping container. You know, standard container, guys. That's the price. Charter rates for short employment have gone out of control, said Alpha Liner in its new weekly report. Depending on the sources, the ship would have obtained anything between $100,000 and $145,000 per day, an absolute historic high. The name of the charterer has not been fully confirmed, although it is believed to be a forwarder. An industry source speaking to American Shipper on condition of anonymity said the rate was $135,000 per day and the duration was 45 to 90 days, one round voyage with an option for a second, and the charterer was Chinese freight forwarder 3Cs. The source said that there is more and more inquiry every day, with people panicking now amid unprecedented times. Alpha Liner said that this colossal rate is substantially higher than the already whopping $70,000 to $90,000 per day, depending on the final duration, agreed during a Hapag-Lloyd for a 2 to 3 month employment of the 4,308 TEU CMA CGM Opal. The industry source told American Shipper that the S. Santiago deal was concluded last week and that he wouldn't be surprised if a new record was reached this week. According to the UK-based valuation and data provider Vessel Value, the 2006 built Santiago is owned by Cyprus Sea Lines and is currently valued at $38.48 million. $38 million bucks, guys, with some change. Not bad for something that can pull in $150,000 a day. To put the enormity of the charter deal in perspective, the ship owner will earn back 1/6 of the ship's value in a single voyage. In a single voyage. Wow. Imagine that. You can't rent a house out for 90 days and earn back 1/6 of that, can you, boys? We're in the wrong game here. What are we doing in Australia? How's it? You know, pathetic. Pathetic. We can't even build ships cheap, though, can we? You know, Australian submarines. When are these Zeppelin new NTs, Zeppelin new techs going to appear, which is going to, you know, start shipping containers around? 1/3 of the vessel's value if the charterer takes the option for the second Whoa, okay. If they go a second voyage, they'll get back 1/3 of the vessel's value. 1/3. Oh, that's... I'm just thinking about that. You know, I rent out equipment, you know, for a day here or there. And over a year, you know, I might pull in a year of rentals here and there, you know, a couple of months. I might pull in a portion of its worth, but not 1/3. Oh, I've got to look into this. So what does this mean for cargo shippers? The historic S. Santiago transaction is yet another big red flag for cargo shippers. Charter rates like this only make sense if freight rates are high enough for the charterer to turn a profit. It also underscores just how tight vessel supply is. Alpha Liner reported that only 2.7% of the global container fleet was inactive as of May the 24th, totaling 660,662 TEUs. Of that, 70%, 461,000, was inactive due to ships being in the yards for repairs or maintenance. And cargo shippers will not be getting any relief in the near or medium term from new build deliveries. There's been a surge of orders recently, but those are for 2023 and 24 deliveries. Clarkson's research services estimate that fleet growth in 22 will fall to 2.5% from 4.6% this year. So what this means for ship lessors. The S. Santiago rate was so high because ship lessors, otherwise known as non-operating owners, much prefer to put their tonnage on multi-year charters and lock in long-term profits. Those electing to accept short-term charters are likely doing so to capture fantasy rates near term, said Fernell Securities, referring to the off-the-charts S. Santiago transaction. According to Alpha Liner, the market has become one of the long-term charters, with 43 of the 51 fixtures reported in the past 2 weeks concluding for durations of 24 months or over. Of that total, 3 charters were for 5 years duration, 9 were for 4 years, 10 for 3 years, and the remainder for 2 years. The medium-term prospects remain bright for the NNOs, affirmed Alphaliner. Listed NNOs include Costamere, Seaspan owner Atlas Corp, Global Ship Lease, Navios Partners, Euroseas, Capital Product Partners, and MPC Containers. Let's just jump over here and we'll have a look. I'll bring up just some charts. Here we have Costamere Inc. This is over the year. They're up. You know, at the beginning of the year they were at $8. They're now at 11.18. Dividend yield at 3.58%. And if we have a look, they've just announced an increase of their dividend. They recommend the board to approve a 15% dividend increase beginning Q2 2021 dividend. And then if we have a look, another one here, Danaos Corp, 67.28 from $3.52 at the beginning of the year, guys. Dividend yield is at $2.97. I mean, yeah, look at that. There you go. There you go. Who got in on that last year, everyone? You know, even if you ever got in on December or even in February, look at that. Up 1,343% in the past year. I'm going to have a bit of a look at these. Up 36% in the past year to date. Here you have, Atlas Corp, up 59.46. And their dividend yield is 3.66%. There you go, everyone. So, it might be worth, we'll look at these in a bit greater detail another time. So, what this means for liners. The record-setting charter market implies medium-term downside risk for liner companies. Today's unprecedented freight income more than offsets stratospheric charter costs, but NNOs are forcing liner operators to accept longer durations to get the ships. If freight rates were to fall significantly by 23-24, charter rates renegotiated in 21 will be much more painful for liners for the bottom line of liners. Zim offers the most extreme example because unlike other liners, it charters its entire fleet and does not own vessels. As of September 2020, 71% of its capacity was chartered for a year or less. The company touted the advantage in its IPO prospectus, stating, "Short-term chartering arrangements allow us to adjust our capacity quickly in anticipation of or in response to changing market conditions." Well, yes, unless you have a global pandemic which throws the whole everything into the stratosphere. But as Zip has rapidly increased its fleet size to capture freight rate upside, charter durations have ballooned. Its fleet size nearly doubled from 59 vessels in mid-May 2020 to 110 as of mid-May 2021. According to Alphaliner, charters by Zip over the past month include the 6,648 TEU Kobe for 44 and 48 months at $45,000 per day, an extension of its charter on the 9,784 TEU Santa Lena for 40 months at $42,500 per day, starting in Q1 22, and an extension of its charter of the 3,534 TEU Bach for 36 to 38 months at $31,225 per day. During the latest quarterly conference call, Zim CFO Xavier Destraziu conceded a shift to longer durations was necessary. "We will continue to bring in vessels in order to capture revenue from new lines we are opening and to renew existing charters," he said. "We are not changing our strategy, which is to continue to rely on the charter market, which is changing. What is changing is the allocation of short-term charter vessels versus long-term charters due to the current market conditions, obviously." So what are these solutions to this? Well, maybe there definitely were some investment opportunities if you had have got into some of these share prices last year when everyone else was being afraid. I mean, there you go, 1,000%. And this ain't like Tesla, guys. This is a business that makes money and pays dividends. That's kind of different. Shipping, is gonna keep going. It's gonna keep going. It's boring. That's what you want. You want boring investments. At least that's what I'm interested in. Well, there you go. I'll have to do a video looking at all of these different shipping companies. But I mean, global shipping is an integral part of trade, everyone. And I would argue prices will normalize over time. Are there still some opportunities? We'll have to see. As always, thanks for watching, everyone. If you're a fan of the channel and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. Take care, guys, and I'll see you next time. Bye for now.